Hello everyone. Welcome to the monthly review of the economy. We will cover three issues in this podcast. Number one, economic activity. Number two, inflation and monetary policy. And number three, trajectory of exchange rate, which is INR to US dollar. Economic activity first. Industrial production in the month of March 2024 was slower than in February, but still a healthy 4.9%. The economic activity remained strong even in the month of April, which is the first month of the current fiscal year. GST collections at 2.1 trillion rupees in April were the highest ever monthly collection. This is considered as an indicator of underlying strength of the economy, its formalization, and improving tax compliance. PMI for services at 60.8 and manufacturing also close to 60 in April were slightly lower than in the month of March, but still in a very strong expansion zone. So overall economic activity in the beginning of the current fiscal year continues to remain strong. On inflation, the progress is very gentle. The sticky food inflation is preventing a swift decline in overall inflation. Food inflation was sticky at around 8.7% in April, while the overall inflation did nudge down to 4.8% from 4.9% in the month of March. The ongoing heat wave in India can keep food inflation high, particularly in the vegetable category. Core inflation, on the other hand, is quite benign, and fuel inflation continues to remain in the negative territory. So what does this mean for monetary policy? The central bank is unlikely to cut rates anytime soon, as food inflation continues to remain a worry, and the US rate cut expectations too have been pushed ahead to December. We now expect RBI to start cutting rates by the month of October this year. For the fiscal 24-25, we now expect 2 rate cuts instead of 3 expected earlier. On the rupee, the INR has depreciated mildly in the last 1 month due to volatility in capital flows and also because of the firming up of the Fed stance. In this fiscal, we expect only a mild weakening of the currency overall, for the following reasons. Number one, capital inflows will remain strong. One, because India has been included in the JP Morgan index, and that could lead to a capital inflow of up to $30 billion according to some market estimates. And also the inclusion into the Bloomberg index will also bring in 2 to 3 billion US dollars. Now, besides these steps boosting investor confidence, which typically lead to more capital inflows. Now, while capital flows overall are expected to remain healthy through the year, the current account deficit, which reflects the requirement of foreign savings, will be benign at 1% of GDP according to our estimates. This, together with a forex kitty of $645 billion, will lend stability to the rupee in this fiscal year. And so the rupee will see a mild depreciation overall. Thank you very much for listening in. See you next month.